This is the Asia Train. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Oil lower and Asian stocks set for a negative open, with traders digesting a flurry of headlines on the Middle East. US equities are notching fresh record highs as Israel and Lebanon agree to a 10-day ceasefire. President Trump also saying that a permanent peace with Iran is looking very good as the clock ticks down to their temporary truce. But Gulf, Arab and European leaders fear a lasting deal is still months away. And TSMC's US-listed shares slipped despite the chipmaker raising its 2026 revenue outlook, underscoring the resilience of AI demand.
Yeah, still that upbeat forecast really supporting tech stocks in the overnight session. So we have the Nasdaq 100 seeing its longest winning streak since 2017. The S&P 500 also notching another record high above that 7,000 level. We continue to have the Iran war ongoing on the background, but perhaps a little bit of headline fatigue setting in, and the tech conversation again dominating the narrative, especially given that we heard that Elon Musk's team has reached out to the chip industry for their Terafab project. We're talking about the likes of Tokyo Electron, Samsung Electronics in South Korea. You can see right there, Kospi futures finished to the upside, while Nikkei futures are now seeing a little bit of upside early in the Asian session. Already, Japanese stocks had touched a record high. Of course, we have seen exporters lead the gains. The Japanese yen very close to that 160 level against the US dollar, but we saw a little bit more strength in the previous session, given the Japanese authorities have come out trying to defend the currency. In fact, we'll be hearing anytime now this hour from the Bank of Japan Governor Ueda, not to mention the Finance Minister Katayama, speaking both out of D.C. Heidi.
Shery, when it comes to the open of trading in Australia, we're expecting mild downside, indicating with futures looking like downside of just about 0.1% once we get into the cash session in the next hour, following the losses that we saw in the previous session as well. We're clearly watching gold as well in terms of how we're finishing off the week. Precious metals, gold in particular, heading for that fourth weekly gain, again on the back of optimism for that truce there, as well as implications for the US dollar. But front and centre, as you say, remains oil prices as well, right? We see that drop at the moment when it comes to crude prices. We'll wait for Brent to come online as well. President Trump still sounding quite optimistic about the prospects of a permanent deal. The IEA also, the director, Fatih Birol, warning that it could take up to 2 years to recover, that a significant share of oil and gas production has been disrupted, regardless of really what happens from here. But the president does say Washington is going to make a good deal with Iran as the two sides discuss that extended truce. The current ceasefire, remember, expires next week. US Defense Secretary Pete Hegseth says the US stands poised to restart military action.
We are reloading with more power than ever before, and better intelligence, even more importantly, better intelligence than ever before, as you expose yourself with your movement to our watchful eye. We are locked and loaded.
Let's bring up Bloomberg Politics editor Laura Davidson. So a reminder there from Pete Hegseth that this war is far from over, even as, of course, President Trump is sounding very optimistic.
Yes, we really hear mixed messages, even just in the past 12 hours or so, from the president saying he thinks that there might not even be need to extend this ceasefire that expires next week, and that a deal could be reached by that point, whereas Hegseth is, suggesting that there could be major military actions yet to come. Trump also announced, in a very optimistic tone, that there was a deal that had been reached that included everything that Trump wants and nothing that Iran wants. So this was, reopening the Strait of Hormuz. It was Iran giving up its nuclear program, agreeing to give over its a stockpile of enriched uranium, as well as, what Trump described as free oil. He did not go into details there, but this is, sort of just suggests, how far, even within the own administration they view this war, and, how far apart these talks are. We also have reporting that European and Gulf allies see this process of coming up with some sort of peace deal taking 6 months or so, which suggests that, that we're really just sort of in the initial phases of this. Trump really, since, essentially the second or third week of this war, has suggested that this, is almost coming to a close. We have not yet seen that come to fruition, and we're still looking to see it, just sort of what this next step might be come next week when the current 14-day ceasefire is set to expire.
Yeah, that's the scary part, isn't it, Laura? Because we keep hearing from President Trump that we are very close to a deal. But when it comes to Gulf leaders, European leaders, they don't expect a deal to be achieved for the next 6 months or so. In the meantime, what does that mean for the Strait of Hormuz? Some people are even warning of a food crisis soon.
Yes, really just within the next month or so. Some experts have said that this could, lead to a global, food shortages if the Strait is not opened. The negotiations here suggest that the Strait of Hormuz is going to be one of the last pieces of this puzzle because it's the piece of leverage that Iran has in this negotiation that they want to, keep that closed because that's sort of the point that they can give to the other side, to the U.S. As they're, talking about the, potential concessions to be made, whether on their nuclear program or their ballistic missile program. So this gets really, really complicated. And of course, the stakes, just increase day after day, particularly as the U.S. blockade has meant that there's been even fewer ships passing through. Iran had been allowing a certain number to go through the Strait, somewhere between 5 and 10 every given day, still far fewer than the 135 that were passing through before the war. But this is really, hitting a point where it's not just a political crisis, it's not just a military crisis, it's becoming an economic crisis and perhaps in the coming weeks, a humanitarian crisis.
Laura, one of the sticking points to the original 10-point plan was whether these Iranian proxies, namely Hezbollah at the moment, would be included in that ceasefire. We saw President Trump hailing this deal between Israel and Lebanon. Can you tell us more about that, particularly as we know that Hezbollah were not at the negotiating table?
Yeah, so this was after a meeting or a call rather between Netanyahu and the leader of Lebanon, and they agreed to a 10-day ceasefire. So what we really see kind of emerging here is that this Hezbollah issue, the proxy group issue, at least how it's being negotiated right now, is sort of on parallel tracks or a separate track from what is happening with U.S.-Iran. This is not what Iran and Pakistan even thought that they were initially agreeing to. In this original U.S. ceasefire deal announced last week. They thought that Hezbollah and Lebanon would be included in that ceasefire. Israel did not agree to that, continued to attack. So now we have a sort of related issues, but separate negotiations happening, which just makes this whole process, which is already complicated, even more complex.
Bloomberg Politics editor Laura Davison there explaining to us a very complex situation around the Iran war. And these are some of the other top global headlines that we're following. At least 2 more empty tankers linked to Iran have sailed into the Persian Gulf. This comes hours after U.S. Naval Forces Central Command warned it would consider boarding and seizing any sanctioned vessels, regardless of location. Observable traffic through the Strait of Hormuz remains extremely constrained. According to tracking data, 2 China-linked oil tankers have sailed out of the Persian Gulf and into the Gulf of Oman. The U.S. government is preparing to make a version of Anthropic's AI model Mythos available to major federal agencies. A memo seen by Bloomberg did not specify when various agencies would get access or how they might use it. Anthropic has limited the release of Mythos amid cybersecurity concerns and has briefed senior government officials on the model's capabilities.
Take a look at the open this Friday in Asia, Shery. Looking like we're going to see some muted trading. Investors weighing the barrage of headlines on the Middle East conflict, the uncertainty over the longevity of these ceasefire agreements. Let's bring Garfield Reynolds, who leads our Markets Live Asia coverage. So on the one hand, you continue to have the president sounding very optimistic, the defense secretary warning that we could go back to military action at any time, and allies, Gulf leaders, European nations suggesting that this is going to be a months-long process. Who are markets listening to?
Oh, markets mostly seem to be listening to President Trump. He started the war, and he very much has the capacity to resume the war. And if the war did resume, if you had that happen, then I do think that oil futures would spike and equities would sell off, and so would government bonds. So as long as there is a ceasefire that is in place, and President Trump is sounding positive about the potential for that ceasefire to lead to a deal, most markets, commodities not so much, but certainly equities and bonds and credit even, are signaling that they expect that there will be a deal relatively soon, and certainly that the worst of the energy shock is behind us. And we can get back to looking at the wonders of AI and buying tech stocks that will benefit from AI, even if there is, even though oil and fuels and so on are more expensive now significantly more expensive now than they were. That's seen as resolving itself, and we can get back to looking at things the way we looked at them before the war started.
But that doesn't necessarily mean that risks are down to pre-war levels, right? I mean, just because we're trading at record highs, what are the challenges ahead, especially when people seem to be looking past the headlines now? There seems to be some sort of headline fatigue, but at the same time, the situation hasn't necessarily changed.
No, I mean, the situation, well, it's to some extent, in fact, I'm more concerned now than I was even a week ago because, as I said, President Trump has moved on. He's busy posting about how Tucker Carlson is a bad person, and there's been the controversies about the Pope. He's focusing more on domestic issues. So he is treating this as though the war has been won. And it's now just about getting Iran to agree to terms, as it were. That's very much how he is framing it. We don't have a lot out of Iran, but to indicate what they're wanting, it seems to me that the take from other Gulf leaders and from European and some other leaders that this is going to take months to negotiate is a fair call. In that situation, the concerns about long-term reductions in supplies of oil, of gas, of petrochemicals, of fertilizer, of helium, and of cement, of aluminum, all of that is still in play. So that raises the risk that the disruption to all of these supplies causes significant damage, significant long-term damage, when markets are busy pricing for, the idea that the worst is behind us. Meanwhile, the IEA, for example, is warning that we've had no new cargoes of oil loaded in the Hormuz region in April. There was a big drop-off in March and none loaded in April. So again, we're left with a situation. We have frozen oil, as it were, tankers that are sitting there in Hormuz. At some stage, they may start to move out. Meantime, we've still got the gap because we're not getting anything loaded now. So that raises the risks. The higher equities go, as they get back towards the trend that was in place before the war, the risk is growing that as we essentially take out the war as a factor, that in fact this disruption to real-world supplies of vital materials will bring everything crashing back down.
Which is also why you've got the likes of some city analysts saying buy the dollar because that inflation impact is still to come, right? When it comes to broader markets, it seems like there's a dislocation between what's going to happen with the Strait of Hormuz and just this desire to chase upside. Is that headline fatigue, or what's really underpinning that optimism, I guess?
Well, I mean, one clear reason for the optimism is, we've in the last few years, we've had the incredible shock of COVID, we've had the tariffs, and markets have ultimately bounced back, sometimes quite quickly from that. So there's an expectation of resilience there that's been built in. There's also the AI boom. One of the things that happened last year was everybody was very worried, lots of people, myself included, were very concerned that tariffs would deliver major disruptions to the world economy. They did, but the bigger disruption for the world economy last year was a positive one, which was the AI boom, and in particular the AI boom spreading beyond just the US. You look at what's gone on and what's still going on with Korea, with Taiwan, with other places, even within China, what's going on with AI there. And China has an AI path that is in fact mostly divorced from Silicon Valley. So that positive disruption is still playing out. And as long as you are expecting that the impact of the war will fade, it does then make sense. There's a logic there that you need to get back into AI and the impacts of that, the positives for the global economy. So if you think Iran means short-term pain, the longer-term gain is brewing in the AI space, and that's why especially after the war saw some sell-offs in places like Korea and Taiwan and the NASDAQ and all that, you've actually got the capacity to snap up those shares at a lower price than you would have been expecting if the war had not occurred.
Garfield, before I let you go, of course, we have been talking about the safe haven status of U.S. assets for a while now, including, of course, the U.S. dollar, but also treasuries. We continue to hear more warnings about the appeal and the demand for treasuries out there. Was the IMF a warning of the premium of treasuries eroding given the U.S. debt picture? Now we have the former Treasury Secretary Hank Paulson also talking about break the glass emergency plan that's needed.
Yeah, well, again, to some extent, this is a sort of back to the pre-war norms, as it were, with some additions. I mean, after all, from the point of view of bond investors, one impact of the war that isn't going to go away is a significant increase in US and other defense spending, which, just sticking to the US side of things, further highlights the likelihood of fresh increases in a US debt burden that was already getting people very worried. You have Trump pushing for that increased defense spending. He's also got other projects where he's keen to increase spending. And at the same time, you've got the potential that some of the savings that he wanted, including the benefit of tariff revenue, those are under threat. So that US deficit potential for it to grow, and therefore for bond investors to demand ever higher yields on a relative basis, that is all still in play. And now that we've got a little bit of space to look at more normal things, that's again coming to the fore. That's going to remain a concern for US and other debt, that yields could go higher if we get severe increases in deficits.
Yeah, same here in Japan, right? The debt doom loop across the world. Garfield Reynolds, good to have you with us. He leads our Markets Live Asia coverage. Still to come on the Asia trade. Japan's finance minister set to speak in Washington alongside the governor of the Bank of Japan. The yen is hovering near intervention territory, and of course, we're very much focused on Middle East risks. This is Bloomberg.
Take a look at what we're seeing ahead of a slightly muted expected open in Sydney. We're watching the Aussie dollar, though, hitting multi-year highs against the dollar, against the yen. On Thursday, the session saw a high against the dollar, the strongest since 2022, but the strongest since 1990 against the Japanese yen. We're also watching Aussie bonds. Are expected to really track throughout the course of the day. Treasuries lower ahead of the key debt sale, the 2031 note due. Well, Australian Treasurer Jim Chalmers says Australia is not changing its tax policies due to the energy shock from the Iran war. Chalmers hands down the country's annual budget next month, and speaking to us in Washington, also said he expects growth to take a hit.
Like almost every country here at the G20 meetings, Australia is expecting to see higher inflation and slower growth as a consequence of this war in the Middle East, and that will play out not just in petrol prices and diesel prices, but also in construction costs and in other parts of our economy as well. We're very alive to that as we finalise our preparations for the budget. Housing will be a key focus in that budget. It has been of the government's first 4 budgets, and it will be a big focus of the 5th. We don't have enough homes in Australia. We're very focused on making sure that we can build as many homes as possible to deal with this shortage, which has built up over a long period of time. And that has an intergenerational fairness element to it as well, which we're focused on, to make sure that we can get more people into home ownership and that there are more homes and more affordable options for people to choose from. So housing will be a key focus in the budget, as it has been a key focus of our government throughout.
Let's drill down a little bit more when it comes to energy, because it's my understanding that there's been a lot of discussion in Australia about raising more revenue from resources like natural gas, including a potential 25% export tax. But I'm wondering, does the backdrop of a global energy shock and war in the Middle East make you reevaluate Australia's trade relationships when it comes to the context of energy exports?
I think it's a really important reminder of just how crucial these trading relationships are to Australia. You know, just in the last few hours, I've met with countries which provide more than half of Australia's diesel imports and around 3/4 of our petrol and aviation fuel imports. And the message that I've been able to deliver to them, which I'm happy to repeat on your program, Tyler, is that we haven't changed our policy on taxes on LNG and energy. We know how important it is that we continue to be a reliable supplier. We have international obligations. And as we put the budget together and we consider all of these suggestions that we get, often quite diverse range of suggestions, we won't be doing anything that threatens those trading relationships or those supply relationships. I've been communicating that directly to our major trading partners here in Washington, D.C., and we've been communicating that publicly as well.
Well, I'm glad that you brought up these conversations you're having, because this White House, of course, has hit Australia with tariffs. President Trump has recently criticized Australia for failing to support the U.S. when it comes to the war in Iran. I'm wondering, in just the final minute, can you give us any more insight into what your conversations this week have been like so far with U.S. officials here in Washington and the response to President Trump's demands?
Well, as you know, the United States is hosting and chairing these G20 discussions, and so Secretary Bessent has been in the chair this morning guiding this conversation. It's been an opportunity for each of these major economies in the G20 to compare notes, to talk through their forecasts, their expectations for how this fallout plays out in our own economies. And so the Americans have been not just a key part of that discussion, but leading and hosting and chairing that discussion. Been an opportunity to provide our views there. Now, more broadly, when it comes to decisions taken here in Washington, D.C., Australians didn't choose the circumstances of this war in the Middle East. From an economic point of view, we want to see an end to this war because Australians are paying a hefty price for it at the petrol bowser, but more broadly as well. There are good economic reasons to see this ceasefire stick and to see the Strait of Hormuz opened. And if and when we can see that happen, we know that this economic fallout will have a long tail. And so that's another way of saying that these engagements are a really important reminder of how high the stakes are, how damaging these developments are for countries like Australia. And they really focus the mind as we put the government's budget together and hand it down in less than 4 weeks' time.
Treasurer Jim Chalmers there speaking with Bloomberg's Tyler Kendall. More ahead on the Asia trade, this is Bloomberg.
You're looking at a live press conference by Finance Minister Katayama, who says she told the G20 that they're seeing huge instability in crude oil markets. It is these crude futures affecting the FX space. We'll have more. This is Bloomberg. You're taking a look at a live feed of a presser by Bank of Japan Governor Ueda, who says that he discussed with the G20 the impact of the Middle East conflict on prices. He's saying that many there have said that the Middle East is a very important factor. We know that this press conference is happening with the Finance Minister Katayama as well in Washington, D.C., who says that Secretary Bessent cited the need for humanitarian aid amid the conflict in the Middle East. Katayama also saying that the U.S. has suggested that the Middle East tensions won't persist for very long, something that Governor Ueda also says that many in that meeting have said that the Middle East situation remains uncertain. Let's actually discuss all of these latest developments in the Middle East and Will Todman also joins us from D.C. He's the Chief of Staff in the Geopolitics and Foreign Policy Department at CSIS. Great to have you with us, Will. I mean, we keep hearing from policymakers, especially citing the U.S. side, Washington, that the conflict will end very soon. We hear it constantly from President Trump. We hear that, according to him, Iran has agreed to some of the terms that it's long resisted, including details about their nuclear stockpile. Where do you sense the negotiations are here?
Well, thank you so much for having me. I actually think that we are seeing some signs that make a deal more likely between Iran and the US. And those signs, I would say, are the fact that the economic pressure that the United States is now placing on Iran is encouraging it to change its perception of its leverage at this stage in the conflict. Just a week ago, I think the Iranians felt very confident. They knew that they were exerting a huge amount of pain on the global economy. And I think they felt that they had essentially survived this conflict and that it was in their interest to drag it out longer. Now that the United States has placed the blockade on maritime traffic from Iran, I think that has changed the Iranians' calculation. And now they're probably more willing to make concessions in the negotiations. And we heard from President Trump today that he said there could be face-to-face talks again this weekend. The other factor I think that is promising is the ceasefire that was announced today between Israel and Lebanon. And that is important because the Iranians said that they wouldn't negotiate while there was an ongoing conflict between Israel and Hezbollah and an ongoing Israeli invasion into southern Lebanon. Now, if that ceasefire proves to hold, I think it does support conditions in which more serious talks can take place between the US and Iran. So we could be getting closer to an end of all of this.
When it comes to Iranian proxies, how also meaningful is it that we haven't necessarily seen the Houthis disrupt shipments through the Bab al-Mandab Strait so far? Because that was the whole point after the closure of the Strait of Hormuz. The next thing was concern about that choke point as well.
Exactly. And it's really interesting that the Houthis have not seriously threatened shipping through Bab al-Mandab, the second strategic choke point in the Middle East, as you said. I think there are probably several reasons why they may not have decided to enter this. It could be that they're feeling too weak after consistent Israeli and US strikes against them, and that they think that the retaliation by Israel and the United States is something that they wouldn't be able to survive. Or it could be that they have been paid off by someone. Perhaps the Saudis have provided financial incentives of some kind to discourage them from doing this, because of course this would have dire effects on the Saudi economy and Saudi Arabia's ability to export oil. Or it could be that they were waiting until the moment of maximum leverage. They wanted to wait until they thought Iran was really facing an existential threat, and then they would play this card. And so perhaps they've determined that Iran has not yet reached that stage. So I think it's possible that they still do come into play if the US continues to have maximalist aims in these talks. That is certainly something that I would expect the Iranians to continue to threaten. But it is interesting that they have not taken part, despite all of the pressure that the US and Israel have placed on Iran up until this point in the conflict.
On the topic of the proxies, obviously the latest development is that 10-day ceasefire being agreed upon by Lebanon and Israel. How much weight do you give to this deal, given that we know that Hezbollah weren't at the table, and we know that some of the sticking points, such as disarmament, are not likely to be agreed upon by Hezbollah? Do you think that it's interesting that this almost seems to be taking place on a separate track to the main negotiations?
Yeah, it is interesting. I think in the short term, a lot of the different parties can claim this as a kind of success. For the Israelis, they didn't want to see a full ceasefire because they want to continue their ability to strike Hezbollah and ultimately to try to defeat Hezbollah. They have kept their ability to stay in southern Lebanon, and they also have a clause in the agreement that says that they can continue to act in self-defense. And so I think that gives them quite a lot of latitude to continue their military operations. This is something they've done after previous ceasefires have been announced with Hezbollah. But for the Lebanese government, this is also, an important victory. It gives some sense of reprieve to Lebanese citizens, particularly those who have been displaced from their homes. More than 1 million have been displaced up until this point. But 10 days is not enough to work through all of the major issues that still exist. Disarming Hezbollah is something that the Lebanese government has been trying to do for over a year. It's had it as an official government policy for the first time, but it is extremely difficult for them to actually achieve this, particularly if they don't receive more international support and financial support to be able to do that. So I think what this ceasefire does is it is a short-term reprieve. It also could potentially allow for these direct talks between the Lebanese leaders and Prime Minister Netanyahu of Israel at the White House. This is something that President Trump has said is going to happen next week. That in itself would be a quite major concession from the Lebanese government, but it may be enough to convince the Israelis that they are serious enough about the task of disarming Hezbollah and buy them some more time to try to get more international support for their efforts to actually advance that process.
A short-term pause in fighting in the region is one thing, but how much in the longer term has this operation added to further instability in the region? Because it doesn't seem, both with the beginning of this operation, this war, and how much sort of planning has been done strategically, diplomatically, when it comes to humanitarian issues, that not a lot has gone into that side. Do you think overall the region is worse off in terms of being a goal of longer lasting peace?
The region is absolutely worse off. I think we use the word unprecedented too many times as analysts, but so many elements of what we have seen over the past month and a half have been unprecedented. The attacks on critical infrastructure, on airports, on desalination plants, on AI data centers. All of these have set a terrible precedent for the future. And I think that is something that is going to continue to plague particularly Arab Gulf states as they try to rebuild a sense of stability and a sense of trust from international investors that that this is a part of the world that is very much open for business going forward. That's going to be a difficult task for them to do. On the humanitarian side, I think a lot of the effects and the consequences of this conflict will be felt in the longer term. Certainly already we are seeing exacerbating humanitarian crises. I mentioned more than 1 million people displaced in Lebanon, more than 3 million people displaced in Iran. But when we talk about food insecurity and the disruption to fertilizers, for example, the effects of that are going to be felt 6 months, even a year down the line. And the food insecurity is expected to spike significantly. And this is something that there was not a plan in place to deal with in advance of this conflict. It seems that the US government had not come up with a humanitarian plan to mitigate these consequences. And so I think that is something that is going to play a heavy cost on the region going forward. And not just the Middle East, but lower income and import-dependent countries around the world will continue to suffer for some time, even if there is actually a deal announced in Islamabad between the US and Iran or somewhere else.
New Zealand's finance minister saying that the war has made the whole world poorer. Will Todman of CSIS, really great to get your views. Thank you. And of course, we follow the economic impact as well from the Middle East crisis. We continue to hear from the BOJ Governor Ueda speaking in Washington, D.C., saying that the G20 discussed the impact of the Middle East conflict on prices, that the BOJ will examine the outlook and risks for their policy decision, but also emphasizing that Japan's real rates are still low, that the policy remains accommodative, and that he will not really be commenting on market expectations on the rate trajectory. Because remember, earlier this week, swaps repriced sharply lower, and the April rate hike odds falling to about 30% from more than 50% earlier on because of some comments that he gave out during a speech where he struck a more cautious tone on the war impact on the Japanese economy. You can see right there, yen holding steady, not much happening with the Nikkei, which is already at a record high. We'll have the open in less than 20 minutes. This is Bloomberg. We're watching tech stocks at the open across Asia. We had the results from TSMC, upbeat revenue outlook, helping drive an early tech rally, but at the same time, a little bit of disappointing on very lofty expectations when it comes to the guidance ahead. The 2026 outlook, the sales are expected to grow about 30% in dollar terms. You can see right there that before the market opens in South Korea, we're seeing some upside in tech names like Samsung, SK Hynix. There were other reports as well by Bloomberg that Elon Musk's team has reached out to chip industry players when it comes to supplying for their terafab project. So we might see some upside from that as well. But let's digest the latest results from TSMC and bring in Bloomberg Intelligence Senior Industry Analyst Masahiro Wakasugi. Masa, what should we take away from the results? Because the forecast seemed upbeat, but then we saw the stock actually falling in the overnight session.
Mm-hmm. All right, maybe the market may be a bit concerned about maybe capex. TSMC revised slightly the capex forecast for this year, maybe upper end of the range, which is $56 billion US. But if we calculate the capital intensity, which is capex divided by revenue, it's still about 35%, which compares with maybe 40% or even 50% in 2021 or 2022. So we think that still the TSMC capex should be the quite healthy level at this point. So I don't have quite a big concern on the TSMC capex, and they are achieving quite a strong gross margin, which is 66% in the March quarter, and they are also expecting a further increase for the gross margin in Q2 guidance. So I think they are keeping a nice revenue and profit situation at this point.
Does that also give us a more positive outlook when it comes to the rest of the chip supply chain?
Yes, and when it comes to the maybe they are talking about the strong guidance from their customer, namely hyperscalers. So they are having a strong request from these end customers on the increasing the capital capex to meet a strong demand, and still they are having a tight supply, and the demand is outpacing the supply. So I think that this is good for the equipment supply chain, including ASML or Tokyo Electron. And also, one another interesting topic was about 3-nanometer fabs all over the world in Arizona or maybe Taiwan and also Kumamoto. So probably in 2028 we will see the 22nd fab in Kumamoto making 3-nano chips in 2028. So which is a quite interesting news.
What about the impact of the Middle East crisis if it doesn't resolve soon?
There was a discussion about the procurement of the materials in the conference call, and TSMC mentioned that they will have no near-term disruption on the materials. So we have to keep on monitoring the situation, of course. But it seems like TSMC is well prepared for the procurement plan.
Masahiro Wakasugi, great to have you with us, Bloomberg Intelligence Senior Industry Analyst, as we look ahead to the start of trade for TSMC in Taiwan, Haidi, not to mention, of course, Tokyo Electron here in Tokyo, Samsung, SK Hynix in South Korea as well.
Also watching Anthropic, Shery, the White House moving to make its powerful AI model, Mythos, available to key federal agencies. This coming even as concerns grow over potential cybersecurity risks. The company is rolling out a scaled-down model called Opus 4.7 with limited capabilities. Bloomberg Originals has more on why the Mythos model is raising worries about the future of security for banks, big tech and governments.
We have been hearing about this theoretical threat that AI poses to cybersecurity. And what Mythos has proven is that that threat is a reality.
And there's a huge concern that these systemically important institutions are at the highest risk of being attacked. Some of the top banking CEOs were invited by the top banking regulators, including Secretary of the Treasury Scott Bessent, to an urgent meeting in DC about Anthropic and its Mythos AI model.
Mythos is Anthropic's latest AI model that it had planned for general release, but has decided to take back and limit after discovering that it could be used for quite nefarious purposes.
It has the ability to detect vulnerabilities in basically every web browser, every computer system that it's so far been tested on.
Largely, it was autonomously able to go and find bugs and exploits and come up with a plan on how to take action on them and potentially do some harm.
You're talking potential holes in infrastructure that these banks might have been sitting on for years or decades and maybe haven't patched up.
That could be finding issues in financial payment services, web browsers, operating systems like on iPhones and Android.
If it's not used correctly, could essentially lead to some of the greatest cyber risks that humanity's ever faced. The Treasury Secretary Scott Bessent called this meeting, and he attended it with Jay Powell, who's the chair of the Federal Reserve. And the fact that the two of them were prepared to sit in a room together and talk to the leading bank CEOs about the same issue shows that this is more than just about politics.
Anthropic came to the decision not to release this very valuable tool for them, rather than letting this out into the world and potentially people using this for malicious intent. They said, we're going to limit the amount of people who can use it.
The risks don't really stop in the US because we've also had the central banks of Canada, the UK as well, not just urging them about the risks that are exposed, but urging them to use the tool as much as possible. So one thing that's really unusual about Mythos is that Anthropic has created this Project Glasswing, which essentially gives its technology in a limited form to some of its competitors.
We know that Apple, Google, Palo Alto Networks, CrowdStrike, the Linux Foundation, Amazon are among the 48 or so folks that are part of this Glasswing project. These are fierce competitors, and Anthropic is not only showing them sort of some IP that hasn't been released yet, they're allowing their competitors to kind of feed back and potentially criticize some of the work that they did.
We've opened this out to a number of organisations, including Microsoft, AWS, some financial institutions, a very small cohort. And essentially, Mythos has really showed us that there are a lot of very severe vulnerabilities right now.
Banks already spend vast amounts on their technology, and that's one of the reasons that companies like Anthropic and OpenAI want to partner with them already.
And over the past couple of years, the major US banks have upped their spending on tech, partially in an effort to stay ahead of these future cyber threats.
Anthropic was really keen to point out that it's not an Anthropic problem. With the speed of the advances in the AI world, similar models with similar capabilities will be available within the next 12 months. It's hard to say, but it's highly likely that people with malicious intent would be very interested in creating a similar model. It's been a huge wake-up call, and that's why you're seeing things like Washington and Wall Street quite rightly concerned about this.
And subscribers can watch that full documentary now on the terminal or our website at Bloomberg.com. You can also find more from Bloomberg Originals on their YouTube channel as well. And also get more on the biggest stories in tech on the Bloomberg Video Hub. You can also check out past episodes of Bloomberg Tech Asia and other shows. Bloomberg.com/videos is the address. More ahead. This is Bloomberg.
Let's get you the latest from the corporate front. Netflix shares fell in late trade following a second quarter forecast that missed expectations. The streaming giant expects earnings per share of 78 cents for the current period, below the 84 cents predicted by analysts. It also announced that its co-founder and its chairman, Reed Hastings, will step down from the board after 29 years to pursue personal interests. The results are the first since Netflix walked away from the Warner Brothers takeover battle.
Our teams were more than up to the task. We've learned so much about deal execution, about early integration. We're really proud of the teams that did all that work. We were proud to win the bid. We are confident in our ability to get to the finish line with regulators for the approvals that we needed. But mostly, we really built our M&A muscle. We met a bunch of great people in the WBD during this process. So if there's any emotion in all of this, it was the disappointment of not getting to work with those folks.
Wall Street banks are said to be tightening their arrangements with private credit funds amid the turmoil in global markets. Sources tell us that lenders such as JP Morgan, Goldman Sachs are exercising their right to write down individual assets while others are raising interest rates. The moves are adding pressure on private credit funds already reeling from an exodus of investors. Footwear maker Allbirds stock sank more than 30% a day after a near 600% surge as it announced a surprise pivot to AI infrastructure. Analysts have expressed skepticism about the company's move and the stock reaction. One calls it a Hail Mary, another saying it has the feel of a meme stock driven by emotions rather than logic.
And we'll be watching the tech trade in the Japanese market opens in less than 6 minutes. And of course, this with expectations of that AI rally to continue. We had seen the tech sector being supported by TSMC's more positive results, the revenue outlook, despite the fact that we saw ADRs under pressure. Elon Musk's team, also Bloomberg has learned that has asked chip industry players to help with their Terafab project. So Nikkei futures at the moment seeing a little bit of downside, but after Japanese stocks already reached a record high, and you can see right there, very, very close to that 60,000 level as we're right now digesting some of the latest headlines coming from the BOJ Governor Ueda speaking in Washington, D.C. about the Middle East conflict and how that's impacting prices. But that also policy here in Japan remains accommodative. We're also hearing from the Trade Minister Akazawa saying that Toto and other home equipment makers in Japan are resolving some of their bottleneck issues. Remember, Toto suspended new orders because of supply issues because of the war in Iran. We'll be watching some of those stocks as well at the open. This is Bloomberg. This is Asia Trade. We're counting down to Asia's major market opens after another record high on Wall Street. The S&P 500 still above that 7,000 level. The Nasdaq 100 seeing its longest winning streak since 2017. Haidi, the war in Iran continues, but perhaps a little bit of headline fatigue setting into the markets, and we're now refocusing back on the tech and AI trade.
Yeah, and I do wonder how much of this is sort of the relentless chase for upside as opposed to any real substantial fading of those tailside risks, right? Particularly as you say, this could just be a sense of geopolitical headlines getting too much for these markets, even as President Trump continues to sound optimistic about the prospects of a longer-term peace deal.
Yeah, Finance Minister Katayama in Japan saying that President Trump, or at least the United States, said that these Middle East tensions shouldn't persist for long. So we continue to see that narrative coming from Washington, D.C. We have heard from the Finance Minister in D.C., Bank of Japan Governor Ueda also in D.C. giving a press conference. So do watch out for the latest headlines coming out of there, because we heard from Governor Ueda that G20 countries were really discussing the impact of the Middle East conflict on prices, but when it comes to Japan, the real rates are still low. You can see the Japanese yen holding steady, very close to that 160 level against the U.S. dollar, very close to that potential intervention level as we continue to hear from authorities trying to talk about bold action to be taken if volatility in the currency markets continues. Nikkei stocks at the moment under a little bit of pressure, but remember, we're very close to that 60,000 level. We were already at those record highs, despite the fact that the Iran war continues, despite the fact that those uncertainties continues. And we're watching JGBs as well with the 10-year yield, which has already reached that 1997 high this week. So do watch out for that continuation of the JGB sell-off that we've seen, especially on concerns about fiscal consolidation here in Japan as well. But we're watching the tech sector, right? Especially the likes of Tokyo Electron. Also, take a look at South Korea. Samsung is in focus as well, because we have learned that Elon Musk's team actually approached some of these chip industry players to help with their terafab project. So Samsung Electronics unchanged at the moment, but we have seen an incredible rally already in the semiconductor space when it comes to the Kospi. A little bit of downside pressure today, but already at the highest levels since February. In fact, about a percentage or so away from a record high, Haidi.
A little bit of downside when it comes to trading in Australia in the first couple of minutes or so. We're off about 0.25%. Unsurprisingly, we are seeing IT tech stocks up by 2%. Interestingly, though, energy holding on to gains by just over 1%, 1.2% at the moment, even as we see that downside broadly trading for crude. We had that optimistic tone when it comes to prospects for a ceasefire, even as we had also some less optimistic views from Gulf countries, from European nations, talking about the broader longer-term economic impact, as well as the IEA itself. Fatih Birol suggesting that it could be months before we see that stability being restored to the market. In fact, up to 2 years to recover that significant share of disruption in oil and gas flows. Let's bring our next guest, who says that equity indexes are acting as though the war never happened, even though a resolution hasn't yet been reached. With us now is Fabien Yip, who's a market analyst at IG International. Fabien, great to have you with us.
Good morning.
So markets continue to try and strive for the upside here.
Yeah, I think it's, like you said, amazing how the rally has been so sharp in the past 10 days. One thing that's particularly interesting is this kind of reminds me of what we saw a year ago with post-Liberation Day rally in the market, where people are looking beyond what's going to happen with tariffs negotiation. They just kept focusing on everything else that's going to be fundamentally resilient, and the market kept rallying. So even by the end of 2025, where tariffs were extremely high and in comparison to where levels were in 2024, market keeps setting new record highs. And today, when you look at what's happening in the indices, as the Middle Eastern conflicts continue and a resolution is yet to be concluded, market is striking new highs. But I would warn that we need to look under the hood as well, because if you look at the US market across the listings, basically 50% of the stocks are still trading below their 200-day moving average. And this signifies that the recovery could be quite vulnerable. And as we move into earnings seasons, I think there are a lot of different corporate news that could potentially give a shock to the rally that we've seen.
What about the recovery that we've seen in AI names?
The rebound has been remarkable, and I think the other boost that we're seeing, of course, is some of these earnings coming from companies like Samsung's preliminary earnings, TSMC, etc. We're still seeing extremely strong demands on the AI side of things. So demand remains strong. These company managements are saying that the war currently has minimal impact on near-term operations. So I think that optimism is also being reflected in what we're seeing in the markets today.
Is the optimism a little bit more selective this time around than, say, 2 years ago, especially when it comes to the tech sector, and that you actually need visibility on the results?
Yeah, I think so. Definitely. I think in the past few months, right, one of the things that we realized is huge CapEx spends from hyperscalers, or even some of the smaller companies, have a pretty serious impact on how investors feel about these companies. So apart from earnings visibility, I think some of the things that we need to watch out for is the quality of the balance sheet, how these companies are spending to improve their AI infrastructure, whether they're doing it responsibly, as well as their credibility in carrying on some of the plans that they talked about earlier, and monetization progress will be things that the market will be watching very closely, and investors are definitely more selective this time around.
What about central bank concerns? Are we going to see a more hawkish bias given the inflation concerns coming from the war in Iran? I mean, we're hearing from Finance Minister Katayama, from Bank of Japan Governor Ueda, speaking in Washington, D.C. right now, that the G20 is discussing the impact on prices. Will the markets be spooked if we see a turn towards a more hawkish bias?
Well, unfortunately, the second order of these supply chain disruptions will take time to reflect. So I think central bankers, when they're making the decisions, they need some sort of data to support the decisions. And it's quite likely that they will need some time to assess what's happening in the market in terms of energy prices, in terms of how that has cascaded to the purchasing power of consumers. So in my view, I think at least for the Fed, they will need some more time to assess that, and it's quite unlikely that they will be making a move until perhaps a new chair comes on board. But there will definitely be quite a bit of uncertainty around what central bank policies will be.
A lot of the attention has been kind of refocused on China as a market that's relatively insulated from these global risks. Do you see opportunities there?
Yeah, very interesting read on yesterday's economic data. China's Q1 GDP has actually is growing 5% year on year, surpassing market consensus. But at the same time, we're still seeing some weakness in the domestic economy, whereby we're seeing retail sales growth slowing down. The property market is still under a lot of pressure. So I think there are definitely opportunities in the Chinese market, but I think people will also have to be quite selective with the companies that they pick, picking the ones that are more resilient with domestic demands and at the same time quite insulated from what's happening in the rest of the world.
Fabien Yip, good to have you with us, market analyst at IG International. We continue to follow some of the big moves across the Asia session, especially when it comes to the tech sector and those chip-related stocks. Tokyo Electron down more than 2.5%. Kioxia also leading those declines of about 3%. This despite the fact that we had some upside in the overnight session coming from Wall Street, especially given that we already saw some gains for some of these stocks, like the likes of Advantage, for example, on that report by Bloomberg that Elon Musk's team has reached out to chip industry players for his Terafab project. They've contacted companies like Tokyo Electron, Lam Research, Samsung Electronics, which proposed allocating more capacity for Tesla at their plant factory in Texas. So we've been following this story very closely, as well as the fact that we saw some downside for TSMC in the overnight session. A little bit of disappointment with the capex numbers, but when it came to the revenue outlook, they actually provided a very solid picture. This is Bloomberg. We're seeing some downside across equity markets in Asia, with the Nikkei falling from record highs and the Kospi also down from its February high. We're seeing some downside for some of those tech names. TSMC fell in the overnight session with some disappointment over their capex numbers. The ASX 200 also down 0.2%. This as we're digesting the latest lines from Iran. Of course, we have heard from, say, the trade minister Akazawa in Japan that Toto and other home equipment makers are resolving their bottlenecks. Those were caused by the ongoing war in Iran. When it comes to the future of that conflict, President Trump says that Washington is going to make a good deal with Iran. This as the two sides discuss an extended truce. The current ceasefire expires next week, and U.S. Defense Secretary Pete Hegseth says the U.S. stands poised to restart military action.
We are reloading with more power than ever before, and better intelligence. Even more importantly, better intelligence than ever before, as you expose yourself with your movement to our watchful eye. We are locked and loaded.
Let's bring in Bloomberg Politics editor Laura Davison. And President Trump, Laura, also claiming that Iran had agreed to some of the terms that it has long resisted. So where are the negotiations right now?
So the negotiations are still in flux. There continue to be sort of these positive vibes that we've had over the past 3 or 4 days that there will be a second round of sit-down talks between the U.S. and Iran, but there has not been a time, a date, a place set for that. But, we've seen sort of Trump come out with a very, very optimistic view here, saying that, there's a deal that he's come that Iran has agreed to. I'll note Iran has not said anything of the sort, but that it would involve reopening the Strait of Hormuz, Iran giving up its nuclear program, its enriched uranium stocks, as well as some sort of free oil, which Trump didn't necessarily detail there. But, this is, Trump has continued really, since like early March to say that he sees this war as wrapping up here quickly. We have not yet seen that play out, and in fact, we've seen, very disparate views, both from where Trump and Iran are in this process, as well as, even just within Trump's administration, his, defense secretary really focusing on the, amping up of troops in the region, the potential for more military strikes to come. So there's a lot of confusion about exactly, if this is going to be something that can wrap up quickly. We also have Gulf allies and Iranian allies telling Bloomberg News, Gulf allies and European allies telling Bloomberg News that this could take 6 months or more. So lots of confusion on the timeline. Though things still seem to be trending positively in sort of some sort of agreement, but maybe not quite what Trump is talking about.
President Trump at the moment speaking at an event in Nevada, saying that the war in Iran should be ending pretty soon. So he continues to sound optimistic. The war in Iran is going along swimmingly, are just remarks that he's making at the moment. How much of this also extends to what we're seeing when it comes to this ceasefire that's been agreed upon by Lebanon and Israel as well, given that we know that the issue in Lebanon is, of course, the Iranian proxy of Hezbollah. They're not even involved in these talks.
Yeah, this is sort of another positive sign, though not necessarily like a concrete breakthrough. So you have Lebanon and Israel agreeing to this 10-day ceasefire, quite a short period of time, and Hezbollah not involved in this talk to the Iranian group. This does remove sort of what had been a key contention point last week in the U.S.-Iran ceasefire of, whether Hezbollah was in scope or out of scope of that. They seem to have agreed to move that sort of to a separate negotiation, which could make it easier if the U.S.-Iran talks are focused more on U.S. and Iranian issues versus having Israel that, was kind of the main party there that didn't agree to Hezbollah being in scope of this previous agreement. So it helps sort of delineate these two separate talks. But this, again, is not sort of indicative that there's going to be a quickly wrapping up peace process here. But it suggests that there's going to continue to be lots of talks to come.
And Laura, we're watching President Trump right now live making remarks in Las Vegas. He's taken his economic pitch around Nevada, Arizona, as well, 2 swing states that he carried back in 2024. How are we setting up for the midterm elections at this point?
Well, this is something that Trump and his allies are very worried about. We heard the White House talk yesterday about how they think that gas prices will be back to $3 a gallon by September, just a couple months before the midterms. That is, cutting it quite close. If you have, a U.S. and allies in Europe and the Gulf projecting that this war is not going to be resolved for another 6 months, that again puts that deadline, right up to the U.S. election, as you have, American voters who are not particularly fond of this war, and instead they're worried about cost of living issues, which will be exacerbated by an ongoing conflict, gas prices, food prices, all of these things. It puts Republicans in a very vulnerable position as they head into the midterms, trying to defend both their House and Senate majorities.
Bloomberg Politics editor Laura Davidson there as we continue to hear from President Trump speaking at the event in Las Vegas, talking about how the war should be ending pretty soon, that the war in Iran is going along swimmingly, that they cannot have the nuclear weapon. The International Energy Agency chief, in the meanwhile, says it could take up to 2 years to restore oil and gas output disrupted by the Iran war. Fatih Birol told Bloomberg that a prolonged conflict will hit energy importing emerging economies hardest, particularly in Asia and Africa.
Gradually improve, but according to our analysis, it can take up to 2 years to see the big chunk of the production coming back to the before war levels. It will improve gradually, but it will not be immediately coming back to the pre-war levels. And some of them may be even longer than 2 years, especially some of the LNG terminals. So why I'm saying this is that we should be prepared to rather volatile energy markets for some time to come. Hopefully, we see that the state is open as soon as possible, and this time frame is shorter.
We have begun with some optimistic assumptions. I think that's good. What if we were to take a more pessimistic perspective? If the war is prolonged, what will the impact be?
Then this will be rather serious implications for the global economy. I would be much more conservative and much less optimistic than the economic growth rates you have just presented. And here the biggest problem will be energy importing developing and emerging countries. They are at the forefront, especially those in Asia. This is, I don't know, Bangladesh, Pakistan, Malaysia, Indonesia, and others, but also in the rest of the world, especially those in Africa. And let's not forget that if it continues longer, not only the oil prices will go up, but as a result of the disruption, the fertilizer supply, we may well see the food prices also going up, and this could damage the economies of emerging and developing countries whose currencies are weaker than others, whose financial muscles are weaker than the others. So this will be a rather serious economic damage on these countries if it takes longer to open the Strait of Hormuz.
Particularly in Asia, in Africa, in emerging markets, in developing countries, are we already seeing a significant economic impact? Are we already seeing demand destruction?
Yes, we are seeing in many countries already some rationing, in fact, of some of the industries are rationed. Their capacity is much lower. We are already seeing the first signs of the upward pressure on the inflation, and this will pass through the rest of the economy soon. And it is the reason I believe we, of course, hear voices from the rather advanced economies in Asia Pacific, in Europe and elsewhere, but the countries that will suffer the most will be the ones who are importing energy, the oil and gas importing countries in emerging and developing world.
The International Energy Agency Executive Director Fatih Birol there speaking with Bloomberg Television contributor Christia Freeland. More ahead on the Asia trade, this is Bloomberg.
Take a look at how Japanese assets are trading early in the session. We're seeing Nikkei stocks falling from record highs. The Japanese yen not really doing much, but we're watching JGBs, of course, still under pressure after the 10-year yield touched a 1997 high earlier in the week. We continue to see this repricing over the war in Iran, not to mention, of course, concerns about the fiscal status here in the country. But let's discuss everything, especially the outlook on the yen, on JGBs, and bring in Bloomberg FX and rate strategist David Finnerty. David, I mean, we also heard from BOJ Governor Ueda speaking in Washington, D.C. Just a few minutes ago. Really not saying much about where the BOJ could be headed, and also saying that he will not be talking about markets pricing when it comes to BOJ's rate trajectory. Of course, markets repriced sharply lower the odds of a rate hike this month.
Yeah, I think that's the key thing. If you go back to pre-war, the markets were looking for basically 69% probability of a rate hike this month. That's gone down now to about 15% as a ballpark. So a big, sharp reduction. The market is sort of looking towards 2, 1 in the summer, 1 towards the end of the year. But what was interesting, as you said, Governor Ueda, and normally the BOJ has a history of sort of with the Nikkei leaks, as often referred to, there's these leaks of like, hey, we're preparing the market for, we are going to hike. He was very non-committal indeed at his comments today. So the market, therefore, is going to go, well, look, you have a history of indicating that may happen. You're certainly not giving us any indications at the moment. Therefore, even though you didn't comment on our pricing, we're going to take it as that it is pretty much in line and that April is very unlikely to be a no-go zone. Of course, if it does, that would definitely be a bit of a shock to the market and give the yen a boost. But at the moment, the market's going up. We have no reason to change our pricing, which is basically saying, look, if you're going to hike, it's basically sometime in the summer, June or July, and then towards year end, maybe for a second one.
You know, there was a time when the Bank of Japan were almost known for coming out with these surprises, right, and shocks to the market. Is that perhaps a page of the playbook that they could return to and they could get, you know, a bit more bang for their buck or bang for their yen, if you will, if they surprise market participants?
Yeah, I mean, look, historically, over the last few years, Japan, or the BOJ, has definitely surprised with some of its decisions. And as you rightly say, if it's a surprise that the market's not expecting, you do get a bigger bang for your buck. And, you know, you have dollar yen at 159 right now. So back in that intervention territory, should we say, hovering below 160, which for the market's a big psychological area. You have Katayama, the finance minister, continues to say, look, we're prepared to take bold action if needed. Certainly a BOJ hike, again, if, this is a big caveat, a big if it was to be occur in April, would give the yen a nice boost. But again, the catch half the time is, look, it's a short-term thing. We bring forward the rate hike. We're looking for 1 or 2 hikes this year. Even if they hike in April, the catch is, well, is it still 1 to 2 hikes this year? We just brought 1 forward. So you get a knee-jerk reaction higher, and then does it go lower? I think an interesting thing to note is if you look at this month, the dollar has generally been in a downtrend versus basically all G10. The one exception is the yen. The yen's down 0.3% versus dollars so far this month. The next one is the Canadian dollar, which is up 1.5%, and leading the pack is the Australian dollar. So basically, it's been a bad month for the dollar, except for versus the yen. So that does give an indication that the yen has these headwinds that it keeps running into. And hence you see Katayama keep warning of these bold actions that they may take.
Bloomberg FX and rate strategist David Finnerty there. Let's take a look at US assets at the moment as we continue to get really that tone of optimism from President Trump speaking in Las Vegas at the moment, saying that they're going to see some incredible results on Iran, that they can't have a nuclear weapon, but that the war in Iran is going along swimmingly, saying that it should be ending pretty much soon. Optimism across the board when it comes to US assets. This is Bloomberg. Take a look at some data that we're just getting crossing the Bloomberg from Singapore. Of course, just another indication of how one of these very externally vulnerable economies is faring given the ongoing concerns, the risks coming from the war in Iran. Singapore March non-oil domestic exports rising 15.3% year on year. An estimate is for a gain of 8.1%, so that is a beat. March electronics in particular rising 74% year on year. It's a good indication of that external demand story. And also we have seen that broader diplomatic outreach for countries like Singapore, including bolstering that relationship on energy flows between Singapore and Australia in a time where we are seeing that continued disruption to energy markets, which we know is also going to have secondary, tertiary effects on everything from food security to fertilizer availability to broader consumer demand as well. So that is the case when it comes to Singapore. We're still seeing that export data hold up. Always interesting to see the splitting out of the pharmaceutical numbers as well. That can be quite volatile as well, but at the moment fairly well held. We had that measured tightening move from the MAS for April as well, still leaving a bit of space for potentially a hold in July for Singapore. Shery.
Yeah, and take a look at how the broader markets across Asia are trading at the moment, because we've been watching the tech sector very closely after we saw TSMC falling in the overnight session, despite the fact that they announced a pretty good revenue outlook that looked pretty solid. But it seems that investors now want proof that these suppliers can actually add that capacity fast enough. TSMC now saying that the second quarter sales will grow more than 30% in US dollar terms, although it's sounding a warning that the Middle East crisis could affect profitability. The chip maker sees revenue as high as $40.2 billion US dollars, beating analyst estimates of about $38 billion. Taiwan's largest company delivered its projection after reporting a surprisingly strong 58% surge in first quarter profit. Joining us now is Simon Wu, head of Korea Research and APAC Technology Coordinator at BofA Global Research. Great to have you with us, Simon. I mean, we saw the solid numbers, and yet investors seem disappointed. Was that more about the capex number, which kind of fell a little bit? What was the issue when it came to trading overnight?
We don't see any issue. Actually, maybe some investors' expectations are very, very high. That should be the issue. But looking at even the memory chip companies, we really believe the new record high revenue with a very high margin profile. So fundamentally, we think the Asia semiconductor chip makers are ready to report very good Q1 result, even with the rising geopolitical risk and concerns. So fundamentally very strong.
Yeah, tell us a little bit about those geopolitical risks and how the Middle East crisis could affect some of their supplies, because TSMC also talked about that.
Two things. Maybe investors' concern is specialty gas from the Middle East. But these days, Asian chip makers already increased the order of the specialty gas, helium or bromine type, to Japan and the US. So gas sourcing is more diversified. We don't see any meaningful disruption for the Asia foundry or memory manufacturing activities. And second point is, chip demand, guess what, is coming still heavily from the US. US AI data center is so critical for the Asia chip makers. So as long as the US big tech companies retain the record high capex spending for the data center, here the Asia chip makers are very, very safe still to deliver. Even, we expect a very strong second quarter result, and also second half earnings outlook, very, very optimistic.
Chemical and gas costs rising as a result of disruptions in the Middle East were flagged by both Goldman Sachs, the likes of Bloomberg Intelligence as well. Is that an area of concern, or do you think the sort of structural story for margins is just too strong going forward?
The semiconductor chip value-added functions is more based on the technology innovation and the manufacturing know-how using the Japan, US, European equipment, and also the chip logistics pretty much based on the air cargo rather than ocean shipping. So we think all the Middle East, the crisis cannot have any meaningful impact on the semiconductor industry.
What are the downsides then? What do you see as the biggest impact? Is it still geopolitics?
No, we think maybe one of the key risk factors for the industry, U.S. big tech companies' capex spending. Whatever reason, if they lower their capex spending, it's going to hit immediately the AI chip demand. Consequently, the Asian chip makers' fab utilization ratio could be down. Today, actually, let's look at the traditional technology product. Smartphone, PC, overall demand is not really strong. But why the chips for the smartphone PC, global supply very tight? Because lots of the semiconductor chip manufacturing capacity being used for the AI data center. So the supply shortage for the traditional legacy, the consumer electronics is a matter of the supply cut or capacity shift from the commodity type chip to more value-added AI chips.
Let's talk a little bit about Samsung going forward. How much strength do you anticipate in these next set of numbers?
Instead of talking some company-specific name, I can say overall the Korea semiconductor industry very, very promising. Number one reason is memory chip which are now considered as a strategic asset for the U.S. big tech companies rather than just a consumable component. For the U.S. big tech companies, they need a memory chip to upgrade their data center and to expand their cloud capacity or AI services. Once they buy the memory chips, they use this as a very strategic resources for their future growth. And also the long-term agreement between the Korean chip maker and the U.S. big tech companies, they will make the memory chip industry less cyclical and also will offer very, very high margin profile with record high level of the revenue. That's the beauty for the Korea memory chip makers. Yeah.
Which is why South Korea is now ASML's largest market, right? But when you talk about those long-term agreements, how much flexibility do these makers in South Korea have to increase prices when there is so much demand?
Keep in mind, the Korea memory chip makers are already enjoying very high margin profile. We think the top management of the chip makers are very happy with the current status. So instead of focusing on the chip price increase, I think their next strategy or next step is to make the memory chip industry more stable and with a long-term based fab operations. I think investors should come to Korea because when you go to Korea memory chip makers, a new fab construction area in Yongin or Pyeongtaek area, the fab size is very big. But that is not for just the 2026 and 2027. Chip makers' investment here in Korea is mainly for 2028 or 2029, 2030. It's a very, very long-term project based on with the customers' long-term agreement. So again, the previous memory cycle pretty much depends on the consumer product, very seasonal, cyclical, short-term oriented. But when you talk with the memory chip makers these days, very, very long-term oriented. And also the chip makers would not be aggressive to raise the price further and further. They really do care global tech ecosystem with a stable price. But current price actually offers a very, very high ROE, ROIC, or margins. So stakeholders must be happy.
So Simon, going back to our initial topic, which was the geopolitical risks and the supply chain disruptions, how exposed are these names when it comes to what needs to come out from shipments through the Strait of Hormuz? Because we're talking about not only oil, but petroleum byproducts, naphtha, that's used on almost every sector in industries across South Korea.
So maybe three areas. Number one, electric power. The electricity is very important to run the semiconductor fab. But here, Korea, we have nuclear power. And also the LNG gas sourcing can be based on the more US or Asia, ex-Middle East. So that may mitigate some electric power shortage concern. And secondly, again, some specialty gas also coming from the Middle East, but the new gas imports are coming from maybe Japan and the US, even partially China. That will also reduce all the geopolitical risk. And the third point is, yes, the Middle East also important for the long-term semiconductor chip sales, but currently the very large portion of the chip demand is for the US-based customers or big tech companies, and also the China still growing, and the ex-Middle East regions is strong enough to absorb the Asia chip production capacity. So we think a second half outlook still very promising. Yeah.
Simon Woo, good to have you with us. He's the head of Korean Research and APAC Technology Coordinator at BofA Global Research. And of course, you can find more of the big tech stories on the Bloomberg Video Hub. You can also check out past episodes of Bloomberg Tech Asia and other shows on Bloomberg.com/videos. This is Bloomberg. Manycore Tech is making its Hong Kong Stock Exchange debut, marking a new chapter for the company as it pivots from China's real estate market toward robotics and AI. Bloomberg North Asia Chief Correspondent Stephen Engel joins us now from the Hong Kong Stock Exchange. Steve, I mean, they were priced at the top of the market range. How big is demand for this company? And give us a little bit of the background of why they're so popular.
Well, absolutely. I mean, the AI craze, of course, on the listing this year on the Hong Kong Exchange has been quite a boon to the pipeline, of course, for the Hong Kong Stock Exchange. And this is the first of those so-called six little dragons that were named following that big DeepSeek moment last year. DeepSeek is also one of those six little dragons, along with Unitree Robotics that makes humanoid robotics. And other companies out of Hangzhou. So this is the first of those six little dragons of the AI startups set to begin trading to do their IPO. They had initially, as a sort of a 3D software services company for the property sector, making interior design licensed software. They're transitioning now. And they had originally a few years ago applied to have an IPO in New York. But that was scuppered for various reasons, including increased regulatory scrutiny by the Chinese government over Didi's listing in the United States. So they kind of pulled back, refocused their attention to the AI space. And that really, one of the co-founders, Victor Huang, who we'll be talking to later here, following the banging of the gong, he essentially says this is a turning of the page, the next chapter in the development of this company, from property, 3D, interior design, licensed software maker, to robotics and the AI world. It's going to be an interesting transition for sure, and there's great interest, 1,600 times oversubscribed for the retail tranche. And you're right, the stock was priced at the high end of the range.
And you're very right, Steve, that there's a big challenge for what is essentially an interior design software services company like Manycore to pivot into AI, to set itself apart, to be able to get an edge on the competition.
That's right, because if you look at, software as a services company, many of them, like Salesforce, Adobe, they're having their own troubles adapting to the competitive landscape of AI upstarts, sort of taking over their expertise. And essentially that interior design 3D software services model that Manycore employed, PLG, product-led growth model, has had to adapt as well to that sort of new paradigm. And what Victor Huang says is the great new opportunity in China, and that's physical AI, humanoid robotics. The biggest challenge that these robotic companies have, and that we've seen as well in marathon races or various different displays of their prowess, is the adaptation to the physical world. So the goal here for Manycore is to take their 3D modeling expertise for the property sector in interior design and essentially make a physical world simulator for robotics, so they can independently, really, almost agentic AI-like, adapt and interact with the physical world without stepping over and stumbling all over the physical world. So we'll get more insight from one of the co-founders later on how he has to bridge those two business models.
Our North Asia Chief Correspondent Stephen Angle from the Hong Kong Stock Exchange. He'll be speaking to the Manycore Tech co-founder and chairman Victor Huang on the China Show in the next hour. In the meantime, let's take a look at how we're setting up, I should say, when it comes to the start of trading in Greater China. We are seeing quite a bit of muted expectations of trading volumes as well as sentiment going into the open, downside of about 0.3% when it comes to H50 China futures there. Taiwan futures, of course, we've been talking about TSMC, but we're seeing pretty much a downside picture there when it comes to trading in Taiwan there as well. Expecting, though, for a little bit of a catch-up across some segments as earnings prospects in the China markets look a little bit brighter. We've also seen fundraising activity gathering momentum there as well. So as with that debut expected today, really on account of that pickup in volumes and IPOs that could see broader, longer-term support. Well, BNP Paribas, for one, is seeing a return of inflows from the US into stocks in China and Hong Kong. Let's get more with our managing editor for Asian equities, Nianting Tu. So, Nianting, some had thought that China's outperformance might fade as we see these Iran tensions ease, but they're managing to hold up.
Yeah, indeed. The mood is quite optimistic out there for Chinese equities. Investors are simply reviving the pre-war playbook for Chinese equities, which is all the AI-related themes. So right now, especially this week, we're seeing the chip makers really ripping higher, and also all these optical fiber operators as well. And that is in part fueled by all these AI models rolled out by the AI giants such as Alibaba and Baidu. Alibaba unveiled their video AI model Happy Horse last week, and this week they followed with a 3D video model called Happy Oyster. So all these things would mean that demand for all these AI supply chain or the components would continue to be strong. And we've seen fund managers, including the one we interviewed this week from China AMC, saying that Chinese AI stocks are not in a bubble territory. Rather, they have room to go just because the AI giants such as Tencent and Alibaba are just beginning to ramp up their investment in AI relative to U.S. peers.
Yeah, you can actually see HSCEI wiping out all of the losses that we saw since the war in Iran began. But how are earnings looking to be this season?
Yeah, earnings are continuing to be expected to be weak just because the consumer demand is still really not picking up. But there are some bright spots that analysts are touting, including the brokerages. We've seen CITIC Securities, which is China's largest broker, unveiling preliminary earnings, which jumped 55% for the first quarter. And that is buoyed by a 70-something% jump in average daily trading turnover for mainland listed stocks. So that is really boding well for the whole sector. And the valuation for China brokerages are still below historical levels. And with animal spirits coming back, as we just talked about in the AI sectors, I think, the bullish sentiment is really building for the brokerage sector.
Yeah, Bloomberg's managing editor for Asian equities, Yan Ting, too, as we head towards the China Open. This is Bloomberg.
Take a look at what we're watching when it comes to trading in natural gas as well as oil prices at the moment. Brent seeing downside of over 1%. We're also seeing a bit of a drop when it comes to European gas futures there as well. But it's interesting that drop coming as President Trump is taking a pretty optimistic tone on the war in Iran. He just most recently said that it's going along swimmingly, that it should be coming to an end soon. We've also had that temporary ceasefire between Israel and Lebanon, if not directly with Hezbollah instead. But we do have doubts being sowed by some Gulf Arab and European leaders saying that the peace deal will take about 6 months to be agreed upon. That we also had some of these concerns from Fatih Birol as well from the IEA, saying that we could see up to 2 years for recovery for oil and gas markets. The near closure of the Strait of Hormuz, Iran's attack on the world's largest liquefied natural gas plant in Qatar have disrupted these gas supplies and sent prices higher. Bloomberg Originals has been looking at the impact of the Iran war on LNG. Let's take a look at a preview.
Natural gas is abundant. Reliable supply is not. Liquefied natural gas, commonly known as LNG, was meant to close that gap.
So I like to think about liquefied natural gas as oil's nerdier cousin.
It isn't as big as oil, but it's becoming bigger, and it's sort of becoming this backbone for a lot of energy systems.
It has so much of a broad reach in terms of where it goes, for power generation, for industry, for transportation. India, Japan, Asia, and also Europe all have long-term contracts.
If you were going to build your economy around liquefied natural gas imports, it had to be reliable. And this is what Qatar offered until now.
The energy war escalates.
Qatar's Ras Laffan industrial city, which houses the world's largest LNG export plant, has suffered extensive damage from an Iranian strike.
This plant, which had been running for 30 years, had never, ever missed a delivery.
Never in the industry's wildest dreams would this facility be damaged, and damaged to such an extent that it would take years for parts of it to restart.
So what happens when a war becomes a stress test for a global addiction?
How do you replace supply from a region that's now so fragile and vulnerable?
And subscribers can watch that full documentary now on the terminal or our website at Bloomberg.com. You can also find more from Bloomberg Originals on their YouTube channel. These are some of the other top corporate stories that we're tracking. Netflix shares fell in late trade following a second quarter forecast that missed expectations. The streaming giant expects earnings per share of 78 cents for the current period, below the 84 cents predicted by analysts. It also announced that its co-founder and chairman Reed Hastings will step down from the board after 29 years to pursue personal interests. The results are the first since Netflix walked away from the Warner Brothers takeover battle. Renault is making growth in India a top priority as the French car maker aims for the country to become an important sales and export hub. It's announced it plans to introduce 4 new gasoline-fired and electrified models there by 2030. CEO Francois Provost told us that India is one of the biggest growth markets in the world.
Now it's time to boost up again outside Europe. And yes, India is my first priority. Why? Because this is one of the biggest growth markets in the world. Probably 40% of the growth of the market in the total market where we operate. But it is also a very demanding market in terms of technology, in terms of value. And we are lucky because we have a full end-to-end ecosystem with 15,000 employees, 6,000 engineers. So it's why I want to focus on India.